Welcome. We're so excited to be able to round out today's conversation. I know we're running a little bit late, so we will do our utmost to keep it upbeat and peppy. We're standing in between of you and wine, so that's on our brains. We'll keep that in mind. I have an incredible pleasure of being on stage with a group of formidable experts in the sustainability / impact / collaborative / future / green economy industry. We'll stick to 50 minutes. We'll leave some time for Q&A. We really want to hear from all of you. And we'll try and keep this, like I said, moving quickly. So I'm going to take a seat now. Okay, cool. Cool. So my name is Rahana Nathu. I am the founder and CEO of Spectrum Impact. We are a impact investing strategy consulting firm. Any opportunity, we were joking earlier, any opportunity for me to be back in New York, I say yes. So when the lovely folks at High Water Women said, let's have a conversation about the future of the sustainable economy, I said, heck yes. And you are looking at 4 individuals that have built long careers dealing with exactly these issues. And so the conversation that we want to have today is going to try and be as controversial and thought-provoking as possible. I think that's what we agreed, and if not, now I've just said it publicly on stage, so here we are, that's what we're going to do. And maybe to kick us all off, I would love if you guys would be willing to tell us a little bit about what your organization does, a little bit about what you do there, and then we'll get right into the nitty-gritty.
Well, I'm happy to begin, and a pleasure to be with everyone. Mark Diaz. I'm a Finance Leaders Fellow at the Aspen Institute and focused on looking at the role of finance in the good society. Prior to this, I founded and led NatureVest, the impact investing division of the Nature Conservancy. And before that, I helped to launch and lead the UNICEF Bridge Fund. I started my career in the urban real estate space, doing affordable housing and community development. So I feel like I've come full circle, really having a chance to reflect across this body of work. The most recent work that I'm doing, and I wanted to share with you all, I've done with a terrific High Water Women collaborator, Imogen Rose Smith. Imogen and I have put together a teaser. We released an Impact Alpha last week about the barriers to institutional investors investing in impact. And so I'll fire these 5 barriers off for your consideration. So tell me if these resonate or not. We'll be releasing some more detailed findings from our conversations. But they are, one, this belief that you sacrifice returns to do impact investing. The second, that this is just really high-cost work, too expensive to do. The third, there's nobody with track record, no performance. And that really relates to governance. No track record, can't take my money. My hands are tied as a fiduciary. The fourth is expectations. You either have to beat all the benchmarks or you're just concessionary. And finally, growth capital. You also need money to build your teams, to build that track record, to close those deals, to meet those benchmarks. So those are a series of the barriers we've seen. Some of those we think really exist in people's minds only, and we also think there's some really important intermediary organizations, institutions, and work that can be done to overcome those.
Yeah, thank you, and we'll get into them a lot more. Sasha.
Hi there, Sasha Brown. I'm with Ecosystem Integrity Fund. We're early stage investors in sustainability related companies. And we could go through and refute probably pretty quickly all of those. My team and I all come from deep backgrounds in sustainability and finance, and we have a pretty sharp focus on getting to top tier returns with a purely environmental thesis, which we have a track record of doing with a pretty small team. So, we are excited to have this conversation and start making more noise about the fact that this is something that can be done and can be done well, and we all really love doing it. My background personally is in environmental engineering, and then for the past decade or so, bringing that into finance. I'm looking forward to chatting with everyone further.
Thank you. Diana.
Can everybody hear me? Yes. Good. So thank you for inviting me to this panel. My name is Diana Propera, and I have been working in the field of sustainability, investing in building companies in green building, energy efficiency, sustainable food systems for the last, 25, 30 years. And more in the last 10 years became quite challenged and frustrated with the short-termism in the venture and private equity markets, especially with some of the companies that I was working with. On one hand, expecting the returns and the impact and wanting to be a good partner. On the other hand, needing to get out or start talking about getting out of the deal as soon as we had made the investments. And so I became quite challenged with trying to balance those two seemingly conflicting approaches. I was lucky enough in 2014 to join Cranemere, which was founded by Vincent May, who ran a very successful private equity buyout shop called AEA Investors for 20 years, who just left AEA, and he also shared some of the disillusionment and challenges in the private equity markets and the short-termism and some of the incentives and misalignment that was created between investors, companies, and shareholders. He started, and I joined Cranemere just a few years ago. And so think about Cranemere as a privately held, smaller Berkshire Hathaway. So we're not a fund, we're a corporate structure. We buy strategic positions, mainly controlling positions, but also minority positions are possible in middle market, privately held companies. We don't have any view to exiting our companies. So once we partner, it's really buy, build, and hold strategy. The thing that probably attracts most companies to us is that we're really considered an alternative to private equity, IPO, or trade sale when a company is looking for liquidity as well as growth equity. And how we integrate impact and sustainability in what we do is both focusing on trying to be a long-term home and acquirer to sustainability companies and purpose-led businesses, as well as all of the companies that we invest in, no matter what industry they're in. We engage them that over a 20-year period to take them to environmental and social leadership through an engagement process called the Environmental and Social Profit and Loss, which some of you might have heard, which calculates every company's externalities, the cost, if you will, of those externalities to the environment and society, and then we set them on a goal of reducing those externalities and hopefully over a 20-year period becoming net neutral or positive. And so that's really what one of the things that we find the hardest, but also the most exhilarating about what we do. So thank you.
Thank you. Jonathan, yeah.
And I'm Jonathan Rose, and I'm a Cranemere Limited partner or investor. But so, it's true. It's true. But I also have founded and run a company, Jonathan Rose Companies, that is almost 30 years old. And we develop affordable and mixed income housing. We are leaders in making it green, and we're leaders in bringing in health, social, and educational services to our residents. We also have a series of investment funds that buy existing affordable housing spread all across America. There's an enormous shortage of it, and it is rapidly becoming either gentrified or abandoned or being taken out of the affordable system. We preserve its affordability. We make it greener, reducing its energy, water, and climate impacts, and we're trying to increase its recycling also. Reducing the use of toxics and making healthier environments. And then we pair that with bringing a whole series of educational, health, and social programs to transform the lives of our residents. There was a very interesting article that was in the New York Times a couple of days ago, maybe last week, about opportunity in America. Opportunity is hugely split by zip code. And so, as many of you know, I bet you most of your children, if they go to a public school, go to school in a district where 90 plus and maybe 90, I went to a school district where 99% of the kids went to college, and there are other districts where 1% goes to college or zero. There are places in America, the healthiest places, you will statistically live 20 years longer than the least healthy place. So we can go through a lot of employment, all kinds of things, poverty rates, opportunities hugely distributed by zip code. Our goal is to overcome this locational bias. So our goal is to take every single project that we buy, no matter where it is in America, we are a national firm, and through the application of our environmental and social programs, make it a mini zip code of opportunity and transform the lives of our residents. And what we have found, this is all designed, interestingly, so everything is mutually reinforcing. And so we can get into the details later or at another time, but every one of our environmental, and I'll just give one example, but of our environmental and social health education programs actually reduces risk and enhances returns. And so if you took all the impact, or if you ignored the impact, just on an economic basis, we've been consistently a top quartile, just regular old real estate fund. That's where our status is very high. We rank very high in terms of our returns, but the returns are entirely driven and enhanced and risk mitigated by our strategy. So just one very simple thing. We will invest equity in any environmental strategy that has a 5-year payback or better. That's a 20% return on equity, and it's, by the way, rock solid. It's recession, it's non-correlated with the rest of the economy. And typically with that strategy will be something like insulation.
Excellent, thank you. All of you touched very briefly on both your aspiration and, I think, concern with where this space is going. So I wanted to start with the longest term view we could possibly find. The trend that convinces you or discourages you that the future will be all impact. If you all could weigh in on that. And Sasha, we'll start with you if that's okay with you.
Sure. So I think there are two mutually reinforcing things that are going on. One is that younger generations are bringing with them a desire and a sense of responsibility for putting capital to work in places that match personal ethics, and that for certain people has more or less of an emphasis on any one of environmental, social, governance, or even more specific issues, but this idea that what we do with our capital matters and we're responsible for where it goes is driving more interest in how do we do that. Reinforcing that is the fact that those of us that have a deep focus on this area actually have top tier returns, and we can talk more about it, but a risk mitigated strategy in a very different way than a lot of traditional investment vehicles do. And what we do in a way represents a real risk to incumbent businesses. So a lot of the places where we see opportunity are disruptions in traditional business systems. So the fact that resources are becoming scarce, that resources are becoming polluted, that consumer preferences are changing, there are businesses that are struggling because of that, because they're using resources that are going away, because they're polluting, because consumers are saying, I want safe and healthy products. We are looking at those trends way in advance and finding where there are solutions that solve those problems, and we can benefit from them. And that, I think, is something that may be hard to see now because we may be few and far between, but that trend is going to become increasingly visible, and then it will be harder and harder to say this is something that can't be done and that we don't know how to do. I guess the last point that I would make is that impact, we all know, means a lot of different things. So the future being all impact does not mean everybody looks the same in the future, but I think that there is an increasing recognition that not paying any attention to environment or social or governance issues means that there are major risks in your investment strategy. And so it starts being seen as best practice to have some ability to analyze them, whether they're core to your thesis or not.
Right, yeah. Mark, you talked a little bit about institutions, and I wonder if you wanted to weigh in on this question as it relates to that.
Yeah, so I really want to pick up on both what Jonathan and Sasha have said about the sort of both and nature of this. Leading institutional investors, the penny is beginning to drop that sustainability is not just a push strategy where you've got a stakeholder, but is in fact both about value creation and value capture. Right? There are genuine improvements in business performance that underlie efficiency, greater resource utilization, cost reduction, and risk reduction. But there's also growth. The biggest challenge institutional investors have is there's not that much stuff to buy, right? There's more wealth today on the planet than there's ever existed in the history of humanity, and it's chasing this fixed set of assets. And one of the few places where we see growth is in emerging areas, often linked to sustainability, particularly around decarbonization, which I'd point to as the area where institutional investors are finally beginning to realize I can both make money because there's a good business story and there will be more of this to put money into. So that's one of those leading edge indicators I think institutions are beginning to internalize.
Yeah, thank you. Jonathan, what about you?
So, so unfortunately, I view the world, so it's going to be a long time before we get rid of fossil fuel and cigarettes and slavery in the fishing industry and a whole lot of other things. So what you're going to, but the impact investing world will rapidly grow. And one of the reasons, so for example, in my field, until 2008, there are many pension funds invested in a strategy of developers or buyers buying existing affordable housing, kicking the poor people out, raising the rents, and delivering great returns.
Right.
And all of a sudden they realized there was a reputation risk that went that, and now none of them are doing that. So the reputation risk issue also will help drive, but I do see that there's going to be conscious capital and there'll be unconscious capital. The other interesting thing will be the rise of blockchain, that blockchain will make information much more transparent and attached to investments, and you'll be able to see chains of data, and that will be very, very useful. So investors will be better informed. There will be, I think you can see the growth of shareholder activism, and what I hope for the pension funds is actually pensioner activism. For example, that example that I gave you was terrible for many of their own employees probably were being kicked out of their housing from these strategies. But I don't see this 100% world, because I see there will continue to be profit also in people doing bad things.
Right, yeah. Diana, what do you see?
Try to be a little more uplifting.
Well, what I'm saying is, this field's going to grow. It's totally going to grow. It's going to be kind of dominant in the pension fund, the responsible investors, foundations, endowment, high net worth families. They'll all be doing good stuff, but there's a lot of other investors too. And
No, I'm joking, because I'm on the same page in many ways. I think that I think everybody in this room probably would love it if the answer were as simple as, we're going to take impact to scale, and it's going to be all in, and it's going to be, 2030. I think the reality is, for those of us who interact with investors, mainstream investors, impact investors, I think we realize that, or at least in my view, impact, sustainability, responsible, lots of different words to your point, remains a niche, or some people view it as an asset class, some people view it as a strategy, but it hasn't necessarily been fully integrated as a standard operating procedure, as a lens through which decisions in all investments are made. And I think that that's maybe it'll come. I think the biggest fear I have is it going to come soon enough, because we read in the newspapers about income inequality and climate change and things like that. And I think, if anything, the sense of urgency that gets expressed in those reports should resonate the most deeply with us and the people in this room, to ask ourselves, are we moving quickly enough? To Mark's points, what do we need to do to really address, the obstacles? And I think the thing that gives me the greatest hope is that the young generation of entrepreneurs who are coming up, who are building companies, don't disaggregate economic, social, and environmental value as what has become of our economy now, where businesses have tended to disaggregate those value creation mechanisms as we become more shareholder focused. I think we see in the younger generation the reintegration of those value creations, seeing them as opportunities, as well as seeing them as a moral imperative.
Yeah. So if the next best step is pace and scale for adoption for this kind of language or education to sort of take root, what are the sectors that you all think are sitting at the bleeding edge? I mean, we should all be paying attention, inclusive of your own? Feel free to pitch to the audience. But in addition to your own, where should we be looking? Jonathan, maybe you can start us off.
Sectors to invest in.
Exactly right. Yeah.
Okay. So to me, the number one and the easiest is green bonds. So I don't remember how many, is it 50 trillion or something? There's an enormous amount of fixed income in the world. And a lot of it is doing really good things. It's financing open space preservation and water treatment plants and schools and things like that.
Right.
And those have the same, you can choose by risk and duration and all the, credit quality, all the things that you want in the bond market. So that seems to me, with just better information, to be a really easy sector to scale very, very rapidly.
Yeah, absolutely. Mark, what about you?
So I've been looking really long and hard the last 4 years at climate change. And this is another place where I think there's going to be ample opportunity, both on mitigation.
Yep.
So there's a lot we can do to slow the pace, a lot of urgency and a lot of tools, but also adaptation. We're past the point of returning to the world as it was. And the sooner we as investors internalize that, accept that the majority of the world lives in coastal areas and that simply is not sustainable, that we will in fact have to make quite significant financial investments to prepare people to live in different ways. And so I think having a mitigation and an adaptation lens is going to create, unfortunately, but also I think practically for us, a real responsibility to be investing against limiting the change that we can and adapting to the change that will come.
Yeah. Sasha.
So I'm hard-pressed to pick a single area, because from an environmental perspective, all of these issues cross boundaries. So a human health issue becomes a green chemistry and pollution issue, becomes a water issue, becomes a food issue. I mean, everything is truly interrelated in the environment. So there are different places that may be better to start depending on the kind of capital you're trying to put to work. So whether it's patient capital or a traditional venture structure or project finance or philanthropy, all of this fits better in different places depending on the given market constraints and urgency and what have you, and that changes rapidly. So what was true 6 months ago was different from 2 years ago, is different from today. So any given strategy is going to find a different place to work depending exactly where we are in time, but it's all interconnected. Yeah. And I think at the base of it, the important point is the set of problems and therefore opportunities for solutions is much, much larger today than the capital available to be brought to bear on it.
Yep. Diana.
So I'm going to take a little different tack. I clearly have been investing in green building, energy efficiency. We're now looking at a lot of sustainable food types of investments. So you can either look at it sectorally, but I think it's also important to think about the business model. I came to understand the importance of that when I was investing in clean technology and realized that the way that wind turbines and solar cells came to market took the same take, make, and waste business model that the coal industry used. And actually, if you think about one of the most polluted areas on Earth, it's in Inner Mongolia, where rare earth minerals are mined for the use in wind generators and other things. Likewise, lithium, significant pollution and social impact on the communities from where it's mined. And it gave me that aha moment that actually we just not only need to focus on the sectors, those are important, but how are those products being brought to market? Most of a company's impact is in that business model. And so we actually have a huge amount we can do in manufacturing businesses, industrial businesses, in really looking at how do we, again, take those externalities out of their business model and use innovation to drive new business models and new ways of producing things so that we're actually changing the way things are brought to market.
Yeah, so you talk a lot yeah, please,
Can I
Jonathan,
answer
please.
something?
Yeah, please.
So the other area where this is not meant to be, well, maybe it'll be a pun, is where there's tremendous growth is in biology.
Yeah.
So first of all, we're seeing a real revolution happening in food production. In the, somebody just showed me an irrigation system use 1/100th of the water of a normal system. And because of a population of 10 billion people and becoming wealthier, we're going to have to figure out the food system. But to get to your point about the take and make and throw out way that so buildings are made of copper, steel, aluminum, glass, concrete, basically. And every one of those is rape the earth and consume it and ultimately throw it out. And we're seeing now this beginning rise of timber buildings in Europe and timber frame buildings, and that'll eventually spread throughout the world. And there's now companies making insulation by growing it as in a mushroom-based system.
Right.
And so the biological-ification of our products, which means that they're organically grown, they're carbon capturing, and they're naturally recyclable, and they cause no waste, and they cause no toxicity to the environment, is a huge growth trend.
Underpinning our conversation is, I think, a broader conversation around education in this space. So if asset owners or even end beneficiaries and entrepreneurs don't have access to your brains 24 hours a day, I mean, what is it about our education process that's lacking in the sector that we probably need to start thinking about, either in addressing myths or challenges or getting access to language or information? I mean, how does that sort of serve as a barrier in your work? Diana, maybe you can start us off.
So I think that obviously being in a holding company structure that is really aspiring to build companies of enduring value over the long term and be a long-term partner. I would be remiss if I didn't talk about the shift to longer-term thinking, which is very difficult to do, but I think really is much more in alignment with the earth and the interests of society. And frankly, I think we're beginning to show it at Cranemere that our thesis that this is actually better for shareholders and better for companies is true as well. I think we, as a community here the impact community has a real opportunity to show leadership in both supporting, backing, helping, whatever those folks who are building longer-term vehicles, so that the deep work of employee engagement, the deep work of figuring out your supply chain and actually changing your supply chain and using natural products instead of synthetic, toxic products, product redesign, process redesign, all the things which will, again, reduce the externalities of a business and lead to better financial performance, which has been proven already, I think, but we can share reports on that.
Right.
Those types of investments are like R&D investments. They don't take 2 years, 3 years, 4 years. When I was in a fund, I was wanting to make some of those investments with my board hat on, but with my investor hat on, I couldn't really justify them because I wasn't going to be around to see the benefits of those deep social and environmental investments that were going to pay off in 5, 7, 10 years. Better branding, higher retention, all of those things. So I think we really have to ask ourselves this question of alignment of values and alignment of time with the visions that we're trying to create, and really what needs to happen there.
Yeah. Mark, what about you? What's the barrier that's stopping this education process in the way that it needs to happen?
I'd say transparency. I think there has been a belief to date that what you owned was what was valuable. So you owned your customer data, you owned as an investor your kind of proprietary insights, and I think what people are having to come to terms with is that in the absence of some forum, some way in which to share kind of what you're learning, what performance looks like, you actually are constrained to only those things you know. So what used to be an advantage is in fact a limiting factor. And so finding ways to participate as an investor, if you have particular values with other investors who share those values, to compare notes, to set benchmarks, to effectively set standards and thresholds by which for an asset class, for a business model, you begin to get reference points. And you know, as an investee, to be really transparent about the things you produce. I'll give you an example. There are a number of companies that think of themselves, for example, as a food company, an agriculture company, but they're also perhaps a carbon sink. Perhaps they're an employment or economic development organization, right? It's not up to you as the company to determine what it is that you produce. It's incumbent on you to focus on what you're trying to do and also describe the performance impacts you're having, positive and negative, because I think that's really where value emerges and where I think you're going to see a lot of gains in sustainability with greater transparency.
Yeah, that's a great point. Sasha?
So I agree that these are, the issues we're trying to tackle are long-term issues, and I think that there's a place, to my point earlier, about how much work there is to do versus how much capital there is to do it. There's a place both for longer term and more traditional fund structures, and part of the way that we at EIF think about this is everything we do has to have a systemic impact, and by that I mean we're looking for market-ready solutions to existing market problems, but they can't be one-offs. They have to be a step in the many steps it's going to take to get us to, whether we're talking about a mitigation or a resilience strategy, to get us to a place that is more sustainable from an environmental perspective. So how do the investments we're making ripple out and ripple forward into greater sustainability for the industries and other industries overall? So I think there are a lot of different ways to take a long-term approach, and part of the issue, to your point, Mark, is how do we communicate what that impact is? Because when it's not just what did we do this year, and there's, I think, a tendency, because it's easy to say, for example, our smart stormwater infrastructure company, how many flooding events did we avert this year? Well, that's fantastic that you can do that, but the larger question might be, how are we building cities, and how are we facilitating more efficient development with existing assets going forward, and how does that change the course of the way something is developed and used? That's a harder question to answer. And so I think that while there's not an easy solution, we have to recognize that the communication, the transparency is going to be a meaty issue for some time to come. So there's a lot of noise around what is real impact, and how do we understand who's an impact fund versus somebody coming in and saying, there's clearly a trend here, and so we're going to stamp impact on this fund without really any background. And there'll be some noise because that won't turn into good results from either a financial and or impact perspective. But the way in which we even discuss how to compare one to another, how we evaluate one investment, one fund, it's a tough question. There isn't an easy answer. And I've sat on panels where people said, oh, we figured it out. We just have an equation, and we can distill it all down to dollars. And so any impact is worth a certain number of dollars, and that's it. I don't think we're there. I think it's a hard question to answer, and it's one we need to continue to grapple with.
Totally.
So your question was education, and right. To me, the number one limiting factor, which we're moving forward with very well, is track record.
Yep.
That although there's been a lot of reports about the industry and the overall numbers and how the impact is better and all that stuff,
right.
People are making specific investments.
Right. And
I certainly know we're now completing our 6th fund, and that it was a lot harder to raise the first one. But as we grow a track record, and we grow competency in this area, that builds investor confidence. And I think as you get a larger and larger pool of investments, that investment managers that have a positive track record, that's really what's going to make the difference.
I think we want to make sure we leave some time for questions for all of you, and then we've got a quick round robin that we'd love to go through with some hopefully wisdom-filled takeaways. Any questions out there in the audience? Anything that you've heard so far? I'll do my best to repeat your question, because I know that you all... Oh, thank you so much. We have microphones on the side. So either make your way or bellow or... No questions? Yeah. They're down at the front.
Just shout.
Great panel. I had a question about scaling all of this. And is there any kind of systemic way we can bring in other kinds of capital, public capital, et cetera, to this cause? I know in some situations there are, but we're not getting enough. So just love thoughts on that.
Yeah. So Richard's question was about scale, and are there other types of capital we can be bringing into this conversation, particularly as we're thinking about growth transparently, with track record, long-term, jargon agnostic. Anyone who, yeah, Jonathan.
So the issue is that most of these impact actually the best impact is generally generated by a smaller entrepreneur that is growing, and they tend to be under the size that institutional capital wants to invest in. Right. And so what we need are intermediaries that impact that institutions, and I am skeptical about the true ability to have impact of some of the very large managers who are offering huge impact funds that I'm not sure they're going to have the degree of true commitment, refinement, principle that you're hearing on this stage. So I think intermediaries that the big guys can invest in and know that they've delegated the responsibility, who have the ability to grow the field by investing in much smaller companies.
I want to build on Jonathan's point on intermediaries. I think it's spot on. I'd go sort of 2 steps further. Some of you have flexible capital.
Yeah.
So I think that flexible capital actually can have higher returns when you leverage it in really meaningful ways, right? So when you unlock a conventional dollar that might not get deployed, or as a colleague of mine used to say, how do you get a 4% deal done in a 5% world, right? Those are the deals that will never happen, right, but for some of your 1% and 2% money. So there is a vital role that leverage on leverage creates, right? So being strategic in deployment of that flexible capital, building capacity in young managers, in emerging asset class areas, and around data for impact. All of those things do, unfortunately, require subsidy in the early days. So where you have the ability to direct some subsidy, whether you sit in philanthropy or whether you're willing to internalize the costs of doing that first impacted data gathering that sets a standard for an emerging asset class, giving that first-time manager a chance, which may cost you nothing other than a governance board meeting and a vote to override the investment committee policy because you've done your due diligence. These are opportunities you all have in this room to, again, build on that kind of base of installed capital that is not going to get released for sustainability.
Yeah, I think the point about intermediaries is spot on, and it's, I guess, near and dear to my heart, because even if you move up from the company level to the fund level, we're a relatively small fund. And so even though we have top decile financial returns, not amongst impact funds, but we are, Cambridge's #1 2011 vintage venture fund against any other venture fund, we're small for a lot of pockets of money, and so it's still difficult to kind of find. It's not an efficient market, so to speak. So having more people that are better versed in how to put impact dollars to work and how to evaluate a fund that is saying, just check out our financial returns and evaluate us normally, but also we're impact in case you care. Yeah. What bucket we fall into, how to evaluate us. There needs to be a better evolved chain of intermediaries and other partners to kind of place. To put everyone together in kind of the right configuration.
Yeah. Any other questions? Seeing no hands, maybe I'll ask one more, and if anyone else is inspired. Oh, yes, please. Yeah. Great question. So what does 10 to 15 years from now, what does that segmentation look like in terms of fund size and sort of access to the market?
Everything.
Everything.
I think it looks a lot like today. I mean, an interesting thing to do is look back 25 years, right? When private equity was emerging as an asset class, there were lots of small funds. Then you have that kind of fund of funds infrastructure that helps to aggregate up all of the sort of subscale funds. And then suddenly you wake up one day and you're like, oh my God, we have all these billion-dollar and multi-billion-dollar and $10 billion private equity funds, and they're that size, even within very discrete geographies and industry areas. I think that will reproduce itself over time. One thing I will say is that the world is getting less capital intensive. So, right, it costs less to start a business. So much of the application of capital is around leaning out resource use, inefficiency, barriers to connecting customers and needs. So perhaps there is something that says there's just more, but I think there will always be benefits to scale, and I think there will always be new things around the corner that start small and that need that space and will have that kind of lumpiness, that inconsistency, and will need that room to grow.
I think in addition to that, everyone's touched on it, but especially at the inception of this work, we sort of thought of concessionary capital, which you all referenced as sort of the kid sister JV table way of thinking about field building. And I think as we have more funds occupying space in the market, the hope is also that we sort of let our foundation, philanthropy, and government partners off the hook on the barometer for importance, and we start saying out loud, you know what, without that 1% to 2%, to your point, Mark, without that 1% to 2%, we wouldn't be here. And so I think a slightly more collaborative way of thinking about multiple types of capital, to Richard's point, also includes a conversation around policy, governance, foundation, philanthropy, all that good stuff. So hopefully that stays in 10 to 15 years. Any other questions? Yeah. Right. Yeah, so the question, political risk. So how does political risk undermine or affect and policy, yeah.
There's probably 5 or 10 minutes a day I don't think about political risk. So political risk is enormous, particularly because of the volatility and inconsistency of the leadership of this country, but we're seeing that grow throughout the world. We're actually in the growth of nationalism. So we're in a very volatile environment, actually. I believe we're actually we're at the beginning of a very volatile environment, and it creates liquidity risk, interest rate risk, government, the regulatory risk, a whole series of risks that I think we have to be continuously scanning and assessing for. And interestingly, our strategy started as trying to figure out where was the lowest risk strategy, which has proven to be a very, very good idea. I actually think that both as investors and as managers, thinking about risk, being explicit about risk, and always trying to figure out where the new one is that you haven't figured out yet is really essential.
I would offer that I've found working across very diverse sectors that there are 3 things that seem to emerge that define viable investments. The first is some form of cash flows, right? Whether it's notional or actual. The second is governance, and I think that's where political risk shows up. What's fascinating to me is that large corporates are stepping into the void that government is creating, right? So who were the first parties to pull out of our forthcoming Saudi World Economic Forum-like conference? They weren't the governments first. It was actually global financial institutions that have really sophisticated risk assessment, right? So in some sense, governance will be the acid test. You're going to see political risk increase if you don't have alternatives. The flip side is that in some sense, you as investors, I think, can look to alternate forms of governance where you have, again, institutional forms that aren't dependent on a single country, that aren't dependent on a single sort of political kind of context. Those are going to be hard. I think there's a lot of volatility, but again, I think volatility is where you drive return. The third thing, as an aside, is delivery capacity. And I also think that's where political risk exists. when you don't have the ability to deliver at the last mile, whatever context you're working in, developing countries, countries where that begins to get jeopardized, I think you really undermine a lot of the ability for businesses to thrive.
Yeah, if I could just highlight something you said very briefly, every investor should spend a lot of time thinking about political and all kinds of other risks. But it doesn't mean that there aren't opportunities at the same time, and the kind of opportunities will shift depending on the political environment, and it's something that we have to be very, very careful about navigating appropriately, taking a long-term view, but being realistic about what the potential impacts are in the short term. So it may be something like shifting from anything that could be touched by a federal regulatory framework to understanding that in an environment where people feel like they don't trust their federal government to protect them from chemicals, from unsafe household products, foods, that they're worried about health and safety, consumer products may be a much more attractive place for people to use their dollars to vote and say, I care about the health and safety of my family, and so I'm going to count on companies that have a high standard for health and safety and the like to deliver products that I feel protect my family appropriately. And so that's a place where we would spend more time in an environment that we're in today, for example. And so there are two sides to that, but yeah, I think all of us probably spent a lot of time thinking about that.
To ride us into the happy hour sunset, maybe one more question from me, but I'm sure these folks have lots for you afterwards. We, especially in our business, we get a lot of investors, primarily asset owners, that come to us and say, I made an impact investment, it didn't work, this is not for me. And a lot of times in reverse engineering what went wrong, it really was a mismatch between the type of capital they had available and the outcomes they want to see. And so in your very long and storied careers, I mean, in terms of lessons learned, the one thing you wouldn't do again, the one trend you've seen that we can avoid in the future to think about the preservation of capital, I mean, what is that takeaway that I think we all can sort of put into effect tomorrow? Mark, maybe hot seat, we'll start with you if that's okay.
Sure. Get to know your teams. Every time, everything can be worked around. But if you don't know the team you're investing in, I don't care if it's 2 people in a garage with something they've sketched out, or the executive team, of a thousands and thousands of person company, with a storied history. Despite all of the discussion we had today about metrics and impact, and this is a human being to human being business, and you're investing ultimately in the capacity of human beings to weather all of the uncertainty and the changes and to use their wisdom and judgment.
Yeah, I'll layer on top of that communication. So even where you are working with teams that you are value aligned with, things change in terms of external factors. So having an open and transparent communication is critical so that you stay aligned and that things don't begin to deviate before you notice.
I would say that, in terms of, since I'm assuming most people here are on the investor side of things, and looking at it from what you can provide, I think it's help with the rigor and the impact, right? So one thing obviously is capital, which is important, but then get a seat at the table. Obviously, you're not going to be able to do that with every fund, every company you invest in, but take a partnership approach in working with the teams that you're backing to help them achieve the impact that they're trying to do, because this work is very hard. Governments haven't figured it out, NGOs haven't figured it out, so it's not going to be any easier for business and investors. So, be at the same side of the table and bring other resources and intellectual capital to support the teams that you're backing.
I would say trust your gut. And when I think about, so I've just spent this time thinking about all the investments I've made and what have worked and what have not worked. And very often there was this instinct. So there's all this analysis, and it's great to have advisors. Actually, it's essential to have advisors who can frame things for you and do due diligence for you, and all that is, due diligence, by the way, it's very interesting. It's just, our firm, we raise a fund, we have over 100 investors, so we get lots and lots of due diligence done. It's really interesting to see the broad range of quality or lack of quality of due diligence is done. It's given me a lot of perspective on it. But in the end, so all that's important, but in the end I've found you're going to have some instinct, and it's just going to feel right or not feel right to you, and that actually really matters.
Thank you.